This was unarguably the most polarizing earnings report from Nikola Motors, where they beat analyst estimates on both top-line revenue and bottom-line EPS, but they also ended up cutting their 2022 production forecast and reducing their headcount by 7%. And this is leading to a big tug of war on Wall Street as to understanding what's the future of this business for the next 12 months, and can this survive this upcoming recession here in America? And that question is exactly what I want to address in this video. But as usual guys, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, let's set the facts straight about Nikola's earnings report. They beat both top line and bottom line revenue and EPS estimates for most of Wall Street, which is incredibly impressive in this kind of time when you have companies like Microsoft, Apple, Google, Facebook, and obviously AMD missing analyst estimates, which resulted in some massive declines in sentiment. But here was Nikola that not only grew quarter-to-quarter revenue by around 33%, but they also ended up having a smaller operating loss than most of Wall Street had expected, which again is quite impressive given the insane macroeconomic headwinds we're facing right now. And if you pair that with the fact that they recently announced a 100 purchase order from Zeem Solutions for their Nikola Tre BEVs, there is really nothing to dislike about the headline earnings report. Well, that's until you start looking into the earnings call and the investor deck, where we see more information about Nikola's future guidance, which is grimmer than most investors had expected. Nikola essentially hinted at them not meeting their 300 to 500 production target by the end of this year. And to be honest, this is absolutely of no surprise. As a matter of fact, I actually mentioned this in a video last month where I said there's a high likelihood Nikola is going to need to cut their production forecast for 2022 because the demand for their trucks is simply faltering as the entire economy is going into a recession in 2022, which is obviously right now much worse than when Nikola initially set out their 300 to 500 goal at the start of this year. And when you had companies like Plug Power also cut their guidance by around 20% for 2022, it's no surprise that Nikola is also going to face those same macroeconomic headwinds, which again are completely out of the company's control. And that is something I think many people are just not understanding. There's things that are inside Nikola's business control and things that are outside. Nikola can simply turn and pivot with how the environment is reacting with this high inflation and high interest rate situation, which is affecting every single business out there. And so really the only thing we can do as investors is compare how Nikola's business is doing to itself over the past 1 year. Has the company made progress over the past 12 months? And the simple answer is yes. Not only did they beat analyst revenue estimates by $2.5 million, but they also reported a smaller operating loss by around $230 million compared to $270 million about a year ago. And that is after the company launched production and started building their Nikola Tres in Coolidge, Arizona. And when you pair that with the fact that Nikola has already ticked off 3 goals that it had set out for the full year 2022 just here in the third quarter, it's signaling that Nikola is executing at a very high level and that as a business, they are much more sound than the equity price would show you. Not only has Nikola already launched their trucks in Europe, but their customer retention and driver feedback has been insane because right now, at least in the US, they're the #1 fully purpose-built electric semi-truck manufacturer. And unlike companies like Byton or Faraday Future who were trying to build their EV platforms completely from the ground up, Nikola has the head start because of their system integration strategies and their partners like Iveco and Bosch. But going back to the earnings call, I have to say that the revenue beat and EPS beat was not the most impressive thing for me. The most impressive and important aspect of the report was the fact that Nikola is going to cut their 2023 OPEX and CapEx by around 20 to 30%. Now let me explain to you why this is huge, because this means Nikola's initial cash burn projections for 2023 are going to be much higher than what their actual cash burn is going to be going into next year. Because not only are they reducing headcount by around 7%, which is again the right move in the right direction in this kind of time, but they're also delaying the phase 3 expansion for the Coolidge, Arizona facility, which was expected to happen in 23. And the reason why this is such great news is because Nikola simply does not need that extra capacity right now. With the phase 2 itself, they can produce at peak around 20,000 units annually. Right now, Nikola is barely delivering 100 units a quarter. So right now, it's much better to preserve this cash and pivot early on than to spend all this money expanding and make the company look good on paper, but actually hurt the business financially. With such an early stage startup, this is exactly the kind of proactiveness I want to see from the management team. And this is why I continue to be an investor in this business despite all the macroeconomic headwinds, because the company has simply improved year on year. They're in a miles better position today than they were a year ago despite the deterioration in the economy. They have around $1.1 billion in net liquidity compared to around $632 million a year ago. And that is after they've already done all the tooling and CapEx for the Arizona factory, allowing them to produce trucks by 3 to 4 units per shift. And this gross margin number right here, which turns out to scare a lot of people, is also improving quarter to quarter with around a 30 basis point improvement. And so yes, in the short term, Nikola is technically losing money on every truck they sell. But that is absolutely not a surprise because they are just starting production. And every single EV company out there has to go through this exact same process. As a matter of fact, Lucid and Rivian's gross margins today are worse than Nikola's. And Nikola is selling heavy-duty Class A trucks. Meanwhile, these guys are selling consumer vehicles which have significantly less CapEx on them. Lucid's gross margin is sitting at around negative 200% right now, and that's after 4 quarters of deliveries. Whereas Rivian's gross margin is sitting a little bit better at around a negative 193%, which is again after 3 quarters of deliveries. Meanwhile, Nikola here already has a better gross margin and is improving at a faster rate than those businesses while having produced only for 2 quarters. And if that is somehow still not enough evidence for you to understand how gross margins work in the EV space, here's a case study from Tesla from 2010 where they first turned out a positive gross margin of around $1 million on $20 million in revenue in July of 2010. And guess what? That was around 2 years after they started producing the Tesla Roadster in the first quarter of 2008. And so if you want to use the same timeline that Tesla used back then you should expect Nikola's gross margin to turn positive with economies of scale in around summer of 2024. But bear in mind that back then Tesla was actually granted a $460 million check from the current administration to build their electric cars, and they also did not build a factory from the ground up. They retooled an existing factory in California to roll out the Roadster. Whereas Nikola obviously today is building their factory from ground up, and they've had no checks sent their way from the federal government so far. And for those folks that don't understand how the Class 8 industry actually works and think that Nikola's revenue to dealers is fake, let me give you a little bit of a reality check. There is not one OEM in America that does not work through a dealer to sell their trucks. Freightliner does not offer any direct-to-customer transactions. They have to always route their customers through a dealer. That is what provides you the least amount of risk when selling a $150,000 vehicle. It's unfortunate that many people in the EV investment space are making comparisons to how Tesla is selling their cars to how Nikola is selling their trucks, which are obviously completely different business models. Just like 80% of all real estate transactions in America happen through a realtor, you have to have truck transactions take place through a dealer. And so if for some reason you're discrediting Nikola's sales because they're sold to dealers, you just don't know how the industry works, and maybe you should be doing more research, because the average turnaround for a Class A truck through a dealer is around 4 to 6 months. And it's also important to keep in mind that this truck costs 2 times the average Class A truck. So the only companies that are going to buy these vehicles are fleets. These are not going to be run by owner-operators, which means they're going to be much more susceptible to the upcoming recessionary fears as they cut on spending and reduce their own positive outlooks. And so any orders Nikola receives from dealers is just as good as any orders Nikola would receive from an end user, but obviously that is simply just not how the industry actually works. And so overall for me, the Q3 earnings report for Nikola was extremely positive. The only negatives were macroeconomic driven and completely out of Nikola's control. But obviously, feel free to also let me know your thoughts down in the comment section below.